Hello, founders. Welcome to Startups.com. We are live. Got a great show for you here. We got a return advisor. Becca Brown is joining us today. I'll let her introduce herself in just a moment. Before we continue, just want to invite everybody who is in the audience, who is going to be watching us, that you can ask questions, interact with us on the interwebs. So feel free, type in your question to the Q&A box right now. And keep those questions coming. We have the illustrious Jen joining us today as my co-host as always, and she's going to be reminding everyone to interact and chat away at the Q&A box and use the chat. We're happy to answer all the questions that you would have for us. We're going to make sure we prioritize those as we continue to learn about startups, all the things that go on with being a founder. We're here to help. We're here to share. Becca, welcome back. As a reminder, tell everybody who you are, what you do.
Great. Thanks, Ed. It's great to be back. So I am an advisor within the startups community, and I run the CPG, which is the Consumer Packaged Goods and Food and Beverage Community Group. We have a monthly meeting. Actually, the next one is tomorrow. So hopefully many of you listening and watching can attend. I've been part of the community for about 2 years now. It's been a wonderful experience. I run a boutique advisory firm called Core Satellite Partners. I help founders with growth strategy and business development from the earliest stages of product development all the way up to scaling and exiting. Prior to that, I ran a consumer brand called Soulmates that was featured on Shark Tank, and it actually started my career in finance at Goldman Sachs.
Fantastic. You definitely have the pedigree. Quick question, just to warm us all up. In your opinion, what is the difference between CPG and other types of startups like software, if you're doing an app? What do you explain to founders and how do you see it differently?
Yeah, they're very different approaches, obviously different business models, different journeys for the founders. For physical product-based businesses, there are a lot of processes in the early stages in terms of identifying manufacturers, obviously if there's any patenting or any IP that can be obtained, identifying, what is the target customer demographic and the sales channels. But really there's a lot of upfront costs associated with manufacturing a physical product. With a software-based company, of course, there are a lot of costs associated with developing that software, but they're not necessarily as upfront intensive as they are for a physical product base. Depending on the type of physical product, you might have tooling to buy upfront. There might be a lot of long lead times before you actually get your products, before you can start selling. Software, you don't really have that issue. With a lot of CPG brands that I mentor and coach, that funding piece is very, very important in the early stages because many times you're outlaying a lot of cash.
Sure.
Many months away from even being able to sell a product.
Let's talk about that funding just for a moment then. You consult and advise both types of startups, all different types of startups. So what do you see as the difference between raising funds for CPG? How do investors react differently? How should founders act differently? And raising funds for, let's say, something like a SaaS?
SaaS is a lot easier. Come right to it. Especially in the last 5 years. I mean, the margins are incomparable, right? So if you build software and you've got a SaaS model, you just have these explosive margins once you establish yourself, and investors love that. Who wouldn't? Especially if you've got institutional money, venture capitalists on the cap table. With CPG, it's about, really penetrating an existing market. And there have been great brand disruptors in big industries, thinking about footwear, like On Running, for instance, a great example. That's a startup that has now dominated a lot of the footwear market. But investors generally a little more cautious when it comes to physical products because of those upfront costs. And also customers and online consumers are so picky these days. And it's really hard to know if a physical product and brand will have staying power or if it's just sort of like a one-off ad. And sometimes investors like to wait that out a little bit to see that there is a real market stake that a CPG brand can take before they want to jump in with their capital.
If you look, let's just talk about Soulmates for a second and use you as an example. What were your margins on that? Just don't give us the gory details, but just generally speaking, what are your margins there?
The gross margins were very strong, and we always had US manufacturing, but it was more about the customer acquisition. So how much are you going to have to spend to acquire a customer, and then what's the lifetime value of that customer? And with Soulmates, we had an initial product that was unique. We had patents on the high heel protector. No one else was doing it. So that was a great inroad to getting that customer acquisition. And then we expanded the product offering to be able to increase that average order value. So we actually had very strong margins, but not every brand can do that. If you don't have something completely new and innovative, let's just say you're a new sneaker company or a new fashion apparel brand, you really have to make a compelling case to your consumers that this is a product that they want to put their dollars behind. And that can be hard because of the changing tastes that the consumers have. And then also looking at the channels on how you're acquiring those customers. through social, through paid digital, it becomes very hard to have a positive return on that investment.
Yeah, I see CPG companies. Like if you're at 30% margin, it seems to me you're doing pretty good. Now, I don't have a lot of experience, but just the ones that I've invested in or have worked with, like pet food or, different things like that. But then let's talk about pets for a second. We were looking at some investments in pet insurance, which was all delivered digital, let's do it digitally, et cetera. And those margins were like 70%, 65%, right? And so it's so much easier to scale. But if you can do it right, a CPG company has such staying power. Like you look at all these product companies, and once you have that brand and people are wearing the brand, you can expand to products like you did. But also you think about like Crocs, who would have thought? And now I see Crocs in all different shapes and sizes, and it's become like a cultural thing. And all they do is make those funny, foamy footwear thingamajiggies, right? But they've done so well for themselves and they're so entrenched now that they're a private equity play. Like private equity, like CPG companies get gobbled up by private equity all the time. I would say more than VC. Private equity company will come in, family offices, different places like that will invest in CPG.
All the time. And part of that is because there is scale, to your point, and also global distribution opportunities if you become acquired by a PE company. Also, the nice thing about CPG is that it's not going to be taken away by AI. So
that's true.
Let's be honest, if you've got a software company and you've developed something that's been really working for the last 10 years, you might be in a situation where you're going to have to really innovate in order for you to stay relevant if AI could potentially take you out or make your service or your software obsolete. CPG, you don't really have that. People are these big categories in terms of clothing and footwear and food and pets and these things that are tangible. They're not going away. They might be improved or enhanced through AI, and there may be additional innovations. But at the end of the day, unless you take the belief that we're all going to live in a virtual world someday, then there's always going to be space for CPG.
For sure. I think it's just so much harder. Well, everything's getting harder to break into these days. But I look at the attendees that we've got in our audience and just being familiar with them. A lot of them are working on CPG, physical products as well, like a hardware type product, or some type of physical infrastructure required to deliver the product. And by the way, for those of you, I see some hands being raised. If you have a question, please drop it in to the chat box or the Q&A, and we'll make sure we answer that. But I wanted to ask you, Becca, if you had to give one piece of advice in terms of how does an early stage founder approach fundraising CPG, what would you say is the secret? Actually, let's back up. Did you raise any money like at all for Soulmates?
Yeah, absolutely. Multiple rounds. Yeah.
Great. So what's the advice that you would give for our founders there who are trying to raise money to make a physical thing?
You have to prove that people will buy it. And whether you have sales, and you bootstrapped and maybe you've got some sales, whether it's 10,000 or 100,000, but if you have some actual financials that you can share, that's a great starting point. If you don't, you need to make a very compelling case that this is a new product brand that doesn't exist and the market is big enough and you're going to be able to acquire those customers in an efficient way that's believable, that the investor can understand how they're going to get their money back, because that's what it comes down to. So traction, I know we talk about that all the time, especially in the raise environment that we've experienced over the last 2 years. Good news, it is improving. Interest rates are coming down.
It's improving.
There will be a lag. So, it's not like the gates are just going to suddenly open and there's going to be tons of funding for all these startups. But you need to really make a compelling case. And ultimately, your investors are investing in your ability to execute. You believe in your product, do everything you can to make it as strong as possible. IP, figure out the go-to-market strategy, do early testing, do betas with your customer base. So you can really have data that indicates there's a strong likelihood to buy. But your investors are going to be betting on you being able to execute that. And be clear with your projections. Be very realistic with your projections too, and test them. We have the nice thing about now, especially with AI and all the different tools we have at our disposal, you can really test your hypothesis about how am I going to acquire these customers? Can I build a community? Can I build loyal fans around my brand? You can do that and actually get really insightful data that will then make your case that much more compelling to your investors.
Okay, but what about the founder that says, but Becca, I need to raise money to actually go out and prove and test and get customers and build my prototype. It's like the whole chicken and egg. The other day, I had a comment on my personal YouTube channel, and they were saying, Ed, it's kind of like you're saying startups have to be successful first before they raise money. And part of me says 100% absolutely, because investors want to come in to something that's more of a sure bet. And if you've already established initial amounts of success and you can show that your money is just pouring gasoline on the fire. The fire's already lit. It's already burning. We can make this happen. But I do acknowledge that there are cases where founders need money to go out and test their hypotheses. What would you say to that founder who's in that chicken and egg with CPG?
I understand, and it is absolutely a very real situation that a lot of us have experienced. So first is you have to get really clear and honest with your numbers. What do you need? What do you really need in order to get that product made? In order to get, even if it's a small set, 100 products, 20 products, whatever it is, what does that cost? And I think a lot of founders, they don't want to take the time to do that research and think, what is my bare bones MVP in software terms? What is my bare bones product that I can bring to market or bring to a private beta situation to get that proof that there will be the customer buy-in? So that's number one. Number two, you have to be resourceful. And guess what? Resourcefulness is going to be a characteristic you will need throughout your entire career as an entrepreneur.
Absolutely. Investors look for that too.
Look for that. In fact, when you have a challenge, whether it's on the fundraising side or the manufacturing side, embrace it, because that will build that resourcefulness muscle in you. And you're going to have to really use that throughout your career. So just being resourceful. So what does that mean? Well, you could look at crowdfunding. Again, knowing what that number is, let's say it's $100,000. Crowdfunding might be a great way for you to raise that and get those initial customers. Maybe you've got a full-time job. Can you save a little bit of money every month to put into the fund to help you get that $100,000? Do you have a small group of friends and family that would be willing to invest in you, maybe as a convertible note or as a safe? Something that will give you a little bit of that extra financial resource to get to that next step. But that comes back to just being resourceful, and you have to be honest with yourself. And how bad do you want it? There's a great book. It's called How Bad Do You Want It? And it's about athletes and performance. And it's really interesting. An example from that, for many, many years, it was thought that a human being could not run faster than a 4-minute mile.
Yes.
And for decades, people tried, and yeah, there were innovations in some footwear and like uniforms and tracks and weather optimization. But until one person did it, it was like all of a sudden all these other people could do it.
Yeah.
And the human body didn't change that much, but it's just knowing that it's possible. And so that's another thing as a founder in that early stage when you're struggling, it's possible. We've, a lot of us have been in these difficult situations, but guess what? You can get through it. You just have to start thinking creatively and being resourceful. And that's one of the values of startups, in my view, this community, where we become such a helpful collaborative community to help each other through these situations.
It's funny because I'll talk to founders. I remember financing a project last year, and how much is it going to cost for you to do X, Y, and Z? And they said $100,000. I said, okay, great. Now, what are you going to do for $10,000? And they just looked at me like I was from another planet. Like, just, are you kidding me right now? Like, it's impossible, et cetera. I said, figure it out. $10,000, that's what you get. And they said, well, we're going to have to cut some corners. We're going to have to use some off-the-shelf software, things like that. And I said, absolutely, just let me know. And what's funny is they ended up producing the exact same results as they would have if they got $100,000. It's just the law of nature. It's like that fishbowl and the goldfish. Like the goldfish is going to grow as big as your fishbowl. So the more resourceful you are, especially in these lean times, some of the best startups are built with minimum amount of capital. And that was my first investor. He's the first guy who bought my company right out of college. And he just said, he ran a family office, billionaire, and said, Ed, access to capital leads to undisciplined decisions. I'm sure you've seen that over and over again, Becca.
It's so true. It's so true. It's a feast or famine. And when you have very little, you make do with that. And it goes back to that conviction and that passion and dedication. And this is when founders are made. If we all had endless amount of money and people to help us and time in the day, we would all be successful. But
Must
we don't.
Nice.
Must be nice. Yeah. And you've got to make do with what you have. Does it help to always be kind of thinking ahead and networking and telling people about your idea and your passion? Yeah, absolutely. Because you never know where those investors are going to appear. And that's another lesson. Some of us, I think at times, and I've seen this through startups, we think that an investor is like a certain type of person and they only hang out in certain areas. They're everywhere. Yeah. They're everywhere. And if you're really your number one ambassador for your business, that you will find them in some of the most surprising places, at a gym, on an airplane, in a restaurant, riding your bike. Like literally they're everywhere. But that goes back to just being resourceful, being creative, and just always having that kind of thoughtfulness forward.
Yes, 100%. Let's take a few questions. I think I saw some Q&A coming in. Correct me if I'm wrong, Jen, but let's pause and answer some questions from the audience so that we keep the questions rolling. What do we got?
All right, we've got 2 questions so far. One being, Ed, you had said that you don't like pages in a deck with superimposed photos in the background. What would you do instead if you're not a graphic designer?
Well, first of all, getting to graphic design is so much easier these days. You'd be amazed. I've tested this out. Spent $50 for graphics on a pitch deck on Upwork or Fiverr, I think it was. Jen, you participated in some of these we tested, and the results were fine. It's all the branding and that crazy stuff that you just don't need to spend money on, in my opinion, in the future. And on top of which, for me, when people over-design their decks because they're trying to get tricky and show how impressive they are, that's when I start to have a major issue. If you think about it from this standpoint. This lends itself to CPG, and Becca, I'd be curious your thoughts on it. But there was this time where advertising was all about a picture is worth 1,000 words, and people came out with ads that were just gloriously designed and all these things. And there's a space for that. But then this whole realm of direct response advertising came up. I remember in the early stages when I was helping startups and my own businesses, I would take out these advertorials that had no images, and it looked like an article, and there was a massive headline. Like your windows could be costing you, $30,000 a year in lost heating and, et cetera. And it would perform great. And there was no graphic design involved. And it's the same principle that I apply with pitch decks. I'd rather see a really smart pitch deck with compelling headlines and the information organized so I can read it with minimal pictures than a beautiful pitch deck that's so convoluted it doesn't make sense. Becca, what are your thoughts?
Yeah, I mean, I think a lot of that comes down to personal preference, and you're looking at a lot of pitch decks, and you probably are looking to just, get right into the meat of it and understand, is this clear? Is this conveying the business well? I think for some brands and some companies, I like the aesthetic flair. I like seeing something that's a little more creative, but it can't be difficult to figure out what the business is all about, and that's striking that balance. And the reality is, if you're raising, you don't know what your investors are necessarily looking for, and you might catch them at a bad moment where they've got fatigue from looking at really creative pitches, and they see yours that's a little more on the text heavy, and they think, wow, this is great. You just don't know, and you can't really control that. I like to see a little bit of a combination, nothing too extreme either way. But I agree, if it's too graphically oriented, I don't understand it. I don't get it.
It's like the Goldilocks principle. You just need to get it just right. But I also can make an argument from your previous world. Obviously, you're looking at startups from all different angles and different industries. But if you are a CPG company, for sure, if you are putting out something that is going to have a brand, I'd like to see some design. I'd like to be able to imagine it. I'd love to be able to say, hey, you and I have a mutual founder we've helped out. Jen, help me out. Who's my guy? Shaddy, right? Yeah. Shaddy. Yeah. Shaddy got investors attracted to him, and I tested out just showing them the cans, and everyone's like, wow, that's a nice design on a can. And his pitch decks were branded properly because it's a CPG company, so you want to put that brand out there. And let me tell you, it doesn't cost a lot of money. You'd be amazed what you can get for very little money out there if you have the proper elements and you're not pushing a graphic designer, making them do, all sorts of crazy things. That's what I think. Who do you use for graphic design and all that stuff?
I have a couple freelancers that I'll go to if it's a big project. Otherwise, I, use Canva and some of the AI generated tools. I just think those are great. Adobe.
Yeah, I use AI. That's my first go-to now. Is if I could just get it done with AI, then it's great. I just did a book cover and I just edited it and nobody could tell, right? Because I was good at prompting. I'm better at prompting than I am at designing. So that's a good thing. All right. Next question, Jen.
All right. Next question is, the startups formula says to research prospective investors, filter, reach out, present. What are your feelings regarding pitch events?
Ooh, pitch events. What do you think, Becca?
I like them. You've got to manage your expectations. We can be allured when we get messaging from the organizers, oh, we're going to have 200 investors in one room and you're going to get to pitch them. Well, that's usually not the case. Maybe there are 50 investors and the rest are just sort of plus ones or fillers. And those people are great and maybe fans and influencers. But I think you just manage your expectations. Always go into those events, whether you're doing a one-on-one pitch or a 200-person pitch. You want to just be consistent. And again, go back to that conviction, that passion. You want to have that energy. But I think that don't go into those events expecting you're going to get $1 million check out of them.
For sure. Pitch practices for me are really great networking and practice opportunities, but I've never seen someone actually get money out of a pitch competition unless it's been set up for a long period of time. Like if you think about it, a pitch competition like Shark Tank, like you've been on, has been set up, but they're mostly really produced. Here's a dirty little secret. I know investors who put on, quote, pitch competitions for PR, but the results are a foregone conclusion. They already know who they're going to award, and they just act like it, and they make the people do it so that they attract more deal flow. If I'm in a room and I'm an investor and I'm surrounded by 200 other investors. Now, if you're at Y Combinator, that's a private pitch competition. But if it's a public thing, just to get the word out there, spread a brand, and I'm an investor sitting there, I'm not looking for deal flow there because I don't want to have to compete with 200 other investors. If indeed there are 200 other investors in that room, my deals will come from, hey, maybe I'll meet somebody and I'll get some referrals, and I want to look in the long tail because I'm looking for that diamond in the rough because that's how I'm going to make money. At the same time, founders can go to pitch competitions and they network with people that they won't pitch to, but someone at the pitch competition knows an investor and they set up a private meeting. I've seen that work out before. So I would say Becca's absolutely right. Manage your expectations. What was it like? Just walk me through, Becca, because all the founders are super fascinated about your Shark Tank experience. Walk us through, like, help us feel what it's like to be there on Shark Tank. I'm just totally curious about it.
Well, before the doors open and before you walk out, you're standing in a little room and they're actually recording you. You don't know that. And I was so everything you're doing is like being watched and recorded, which I think is common for any television production. So I had so much energy that I actually had to jump up and down.
Wow.
And for me, it was sort of an analogous to starting a game. I've always played sports. I played lacrosse in college. So right before a competition, you've just got so much excitement and energy and some anxiety maybe, but I just had to jump up and down. So, and then when the doors open, it's this out of body experience because for me, I had watched the show for so many years and dreamt about going on. And there I was on the set, very much an out of body surreal experience and high stress. And you've probably heard me say this before, but the key to being successful on that show is preparation.
Yeah.
And I could lean on the fact that I knew I was very, very prepared. So I may not remember everything I said because I was having an out-of-body experience, but I knew that I had my bullet points that I wanted to convey. I knew, the financials, I knew all the things to say. And so that's what I could lean on. And so preparation, and that's a really good point, even for these pitch events, which I agree with you about practice, that they're great practice venues, but you've got to know your business and know your key point.
Yeah. I would say my interview down at Y Combinator, I went down in 2015. So this is before they went online and they did it quickly. And so I probably was like the last vestige of Y Combinator interviews where it was 20 minutes, me and my co-founder, 3 people in the room, and it was 20 minutes and it went by. I thought it went by in 30 seconds. Like, that's true. The out-of-body experience, time has no meaning. Like, it is done in a flash. And you're just hoping that you just went on autopilot and said all the right things. But because I was prepared, like you said, like people always say, and how is it that you sort of know what to say when it comes to investors or presenting or any type of conversation? And I say, yeah, it's like pulling a rabbit out of a hat. It's like a magic trick. And they go, yeah. I go, well, that's easy. Just load your hat with 1,000 rabbits and you're going to be good, right? So a question back to you. How long did you prep? Like, what was that prep like for the show to be on Shark Tank?
It was many, many months. I would say it was about 6 months, but probably 3 months, very intensive preparation, including professional media training, which was something that takes, it's a lot of money and it's a full day of working with a professional, but I highly recommend it. But then daily kind of question, kind of Q&A from our staff in our office to just be peppered with like a range of different questions, being prepared for that, like, not knowing what they're going to ask, 2 people asking 2 different questions at once. So trying to create that chaos, which Shark Tank tries to do. So it was about 3 months of intensive preparation. And then I would say 2 weeks leading up to it was like 24/7, thinking, dreaming, sleeping, watching old episodes, researching previous pitches, everything.
Wait a second. Now, was that media training mandatory or is that something you just supplemented as far as what you wanted?
Supplemented. Yeah.
Okay.
We just decided that would be a great tactic. And a friend had suggested that, and it's great advice. And I recommend to founders to look into that regardless of whether Shark Tank is even on the radar, because that can be really a helpful practice because it gives you sort of a strategy and then you can take that to whatever situations you're in.
Okay, great. Jen, what are the questions we got?
All right. It looks like we got another specific question from Lon regarding valuation. So he said, in India, we have 4 potential clients with 1 LOI. How should I value my startup? How do I get precedent? They want him to be successful. story.
Okay, so I've got the quick and dirty answer. Becca, you've got the educational chops. You're a lot smarter at this than I would be, because Goldman Sachs, like, that's just the world that you live in. How should startups approach valuation?
It's definitely not as scientific as you may like to hear, especially now. Valuations have really changed quite a bit, largely due to the funding environment that we've been in, or the macroeconomic environment. It also is very industry specific. So if you've got an LOI, I don't know how big that business could be, that if that's kind of spelled out in the LOI, but that could be significant. If it's not, if it's a smaller kind of partnership, then that may not be something that you can use as a core basis for your valuation. Usually there are two, in my kind of old school approach, there are two approaches to valuation. There's one, you create financial projections into the future and you discount them back to present value. That's one way to do it. It kind of fell out of favor just because of the general environment. The second way is to use comps or comparables. So you take other companies that are in your industry and you look at what the valuations have been historically, and you come up with an implied valuation for your business. With the adoption of safes, which are really deferring the valuation into the future, those approaches have sort of gone away for the short term. So I don't know where you are in the business right now, if you're just getting started, but if you have an LOI and 4 potential clients, I would want to put together those projections, because you're going to have a lot more confidence in those projections because you've got the LOI.
I think it comes down to, which is the reason I appreciate, Becca, you mentioning those 3 avenues. Founders should do the work of going through each and loading their brains up to have a negotiation, because if you are not in revenue, it's very difficult to be taken seriously in many ways. And investors will have different rubrics to do your valuation, and then it becomes a negotiation. So if you can figure that out, and I do corroborate that, totally support what Becca said. The last time that I had to have an official valuation done on my company outside of my negotiation was because of a breakout, okay? Because like I was having a nasty divorce and we had to figure all these things out. So we brought in a firm and they used the comparables method. So they went out, and here's how you do it. You go out and you look at financial reports from publicly traded companies that have disclosed, and you say, if we get to that point in time, we should be worth X amount of dollars. So what makes sense for the investor now to say, based on how much money you've raised and your LOIs and how much business you're doing, what makes sense for the investor to own based on their money, 10%, 20% of the company, knowing that you have a small chance, you can stack it and rank it in your favor to get to that publicly traded company. But that's really your argument is, what if we do become a publicly traded company and we get this massive and huge? Well, then you're going to be this rich. If you put in $1 million right now, you're going to walk away with 300 million, later on, type thing. So when you're at the early stage, because I know the founder asking the question, when you're at this early stage, it comes down to negotiation, your negotiation skills, but do what Becca says. So you've got backup with math on why you're justifying your valuation. Anything else to throw in there, Becca?
I 100% agree. And to your point about the public company, so if you look at an annual report of a public company, even if they don't disclose at the sort of the beginning of the report, a lot of times in the financials, they'll have to disclose what they paid for an acquisition. So just be willing to dig in a little bit, because that can be very, very valuable. If you read a press release about an acquisition, they don't always say what the terms are or what the acquirer paid. But if you look in that annual report, sometimes you may find it in there.
Good tip. Jen, do we have any more questions?
We sure do.
All
We've
right.
got another one here from Chris that says, are family offices interested in early stage SaaS AI tech?
Oh, this is a good one.
Oh,
The reason
good
is
one.
Becca totally, that's her jam, family offices. Becca, take it away.
Yeah, so I'll preface this. There are anywhere between 10 and 20,000 family offices supposedly in the world. That number is hard to really quantify because a lot of family offices don't necessarily make themselves fully visible for privacy and for good reason. But it's a big opportunity. Do they invest in early stage AI and whatever else the company does? It depends. If you can find them, some of them do, but some of them don't, because if this is a multi-generational family office, chances are they may have a little more of a conservative investment management bias, meaning they're charged with preserving the capital, and venture and early stage direct investments don't always align with their approach to the asset allocation of the family wealth, but they can be a great resource and a great investor if you can find the right ones. I will say that if you're targeting sometimes maybe first or second generation family office might be a little more entrepreneurial or founder investor inclined. A lot of the wealth that has been created through technology in the last 20, 30 years, those I would say are a little more interested in some of these early venture and startup investments. If you're talking about a 1,000-year-old family from Europe that has a couple operating businesses, they may be less inclined.
Sure.
But it definitely is it's a great set to explore. But again, it's a little trickier to find them because they're not like a big wealth management firm or a big venture capital firm where they have a lot of public kind of information available.
Let's talk about family offices just as an alternative. I'll share the story, and I'm wondering, based on your experience, how common this is. I've only worked with, well, actually, me and Jen here, we worked for family office together. That's how we met. But if you're looking at a family office, I advised a founder once, and he had taken a company public. He was the chief operating officer, I think, and he ended up divesting and said, I want to move on. And then I found out that he actually is a member, or he's one of the family members of a very, very wealthy family office. And he had sort of left the family office because he wanted to do his own thing, stand on his own. And then he decided, and this was a lot of our conversation, do I want to go back to the family office? So I was doing a lot of executive coaching. And so he goes back to his family office and he says, all right, I want to put my mark on, our generational wealth. I want to do this. I want to be engaged. Because they owned like dealerships and convenience stores and franchises, and they were totally set, right? And they wanted their kids to sit on the boards and just get the business because it's generational wealth transfer. But he comes in, and I can't remember what he ended up doing, but he said, yeah, I want a chunk of money and I want to put it into tech. I want to put it into speculative ventures. I think he ended up getting $40 million from his family office. I can't remember exactly because he just got too busy and he didn't need me anymore. And rightfully so. I was like, have a good life. Don't forget about us. But I think that if you can find those younger generation types, like you said, second or third generation, who now can make the decisions. They're coming into that transfer of wealth and they want to be engaged and they don't just want to run the portfolio. I think if you can find those individuals, you could probably pitch them and get favorable results. Am I just totally talking out of my ear here, or what do you think, Becca?
I think that's right. I think, though, you have to bear in mind that they're likely getting pitched from a lot of people. So,
Yeah.
Because of that. So I think it helps to do your research and be prepared, all the things that we've been talking about, but also make it easy to understand why does it align with the operating businesses, or is it a complete departure? Is it going, to your point, is it going to give that next gen family member something of his or her own because it's so different from the other businesses that the family has owned? So you sort of have to choose the angle and figure out what might resonate with that particular individual. But I think it's definitely worth exploring, but just be mindful that they're probably getting hit by others.
Let me present to you a scenario and you tell me what your experience has been. I saw the comment just happen and says that family offices seem to be wanting to diversify and get into tech. And I would say that was true up until about 2022. Yeah. So what happens, you have to understand. So let's break down what a family office is so you understand. Let's put yourself in the shoes family office. Family office is typically some matriarch, patriarch, somebody in the family strikes it rich and they're doing really well. And then they decide, I want to pass my wealth on next generation, plus my business. I don't just want to exit. I actually want to keep this going. So there are a whole bunch of different tax advantages and benefits. And I work with senior family trusts, which are basically family offices doing different things. They go out and buy banks and they do all these things and they work in the top 1% like some of the big guns do, right? And what happens is they need to come up with strategies. So they all need an investment thesis. And sometimes they tell their kids, all of you get a chunk of money, go out and figure things out, et cetera. And so they're looking at the market up until 2021, all these crazy IPOs happening. And the family office are thinking, should we have been investing in tech up to this point in time? Because we missed out on Airbnb. We could have got in on those. And the kids are saying, oh, this great Snapchat is wonderful. I'm using X and like Facebook all the way back in the day. But then family offices have to make money. So then if you followed the money from 2022 onward, if you were in startups, you lost. Like you were down 40% at minimum. But if you were in the public markets like the NASDAQ, just at a sheer, hey, this is where we're going to park our money, you would have been up 40%. Right? And so family offices are going to say, well, why are we going to invest in tech when we could just park our money into some big basket of funds out there for the time being until they start to see tech give these outsized returns again, then they'll start to diversify. That's my experience how family offices operate. What about you, Becca?
Yeah, that's in line with my experience as well. And that goes back to just the conservative approach. Usually the people that are managing the wealth within the family office, because there are other departments like the estate planning and the accounting and things like philanthropy, but the people that are actually doing the asset allocation, they're going to be more conservative with that timing. They're not going to jump on certain things that, you know, the rest of kind of the market participants might be perceived as doing. So, and a lot of them, and the other thing is you can just ask if you have a connection to a family office or a family member of one of these high net worth families, you can just ask the question if you have a relationship, does the family invest in direct investments or do early stage investments? They'll tell you because that's, you know, they're not going to beat around the bush, which is actually refreshing because sometimes you go to people who you think are investors and they're not, and that's a waste of your time. So you can just ask them outright, is that part of the portfolio? Is there an allocation to doing direct investments in early stage companies? And if there is, they probably have a program where you either can pitch to an investment committee or maybe there's a subgroup that you can, you know, share information. But it sort of all depends. There's no one size fits all with these family offices. But I think that that's just it. They're generally going to be a little more conservative. Now, they do have performance sort of goals and requirements. And so the portfolio as a whole has to be able to support those goals, and venture, when done well, obviously can produce some pretty extraordinary returns. But a lot of the family office, if they want exposure to that asset class, they may prefer to go with a venture fund because then they're diversifying the deals instead of a direct investment into one early stage company.
Now, I have seen family offices participate in roll-ups. So they'll say, we have an investment thesis in this type of industry, so let's go acquire or invest in a portfolio of companies that will then support that, or they'll roll it all up and say, we're going to take this company public, or things along those lines. So again, they're all over the place. And that's the good thing about family offices, and that's the infuriating part of family offices, is their investment theses are all over the map. And so you just have to do your research and find out and do your networking. So that's great. How do you normally meet your family offices, Becca?
You know, a mix of just colleagues from my time in finance and people I've met along the way, operators I know who have had liquidity events. You know, it's just one of those organic things that has evolved over the years. And I think if you think about that for any type of network or community you're trying to kind of establish yourself within, just recognize that, again, like those investors, they kind of are everywhere. They just don't all have labels above their heads.
Yeah, it'd be nice if they did, with a QR code on how to apply. So let's do that. Jen, other questions? No other questions?
It looks like we've gotten all questions.
Okay, fantastic. Feel free to interrupt us if more questions come. All right, Becca, we're going to have a little bit of fun. I want to get your opinion on a pitch deck. And I picked this pitch deck because I think we could probably relate on many levels. But we do this because I want the founders to experience what it's like to have other people look at your pitch deck than just Ed. I think what happens is people say, oh, Ed's the most obnoxious guy when it comes to pitch decks. Let's keep sending our pitch decks to Ed. But I'm only one person. And so getting this perspective, I appreciate all the founders who've ever sent your pitch decks. If you have a pitch deck that you want to send in, if you're part of Startups.com, we'll review it for free as part of your membership. But if you're not part of Startups.com, we'll take it and turn it into a piece of content. But you're going to get some feedback from amazing advisors and other people like Becca. But I wanted to show this pitch deck and just get your reactions to it. And then I'll give a play-by-play commentary. It'd be kind of like, you know, I don't know if you watch football, but there's always like the guy who just calls the regular plays, and there's always someone who just adds in the technical analysis and adds in the color and makes it exciting. That's going to be you, Becca. You're going to make this exciting. I'll just give the straight play-by-play. All right. So the first deck, the one that we're looking at today, is Sneeko, and it says order laundry from nearby laundromats and get delivery within 2 to 4 hours. What's your immediate impression on this?
I'm a little confused by the description. Order laundry from nearby laundromats and get delivery within 2 to 4 hours. So order laundry, I don't really know. Does that mean they're going to come pick up my dirty laundry and wash it for me and deliver it to me? I'm a little confused.
That's right. Okay, so that's great feedback. So let's clarify this opening statement, and it's like, get your clothes washed and picked up, delivered by local laundromats in 2 to 4 hours, something along those lines.
Something like that.
Okay.
Yeah, something like that.
Let's take a look at this. So the problem statement, I like that it's brief with one sentence up at the top. Independent living individuals in tier 1 and tier 2 cities. This, by the way, I believe is in India, which is where they, like I know in China, they classify cities tier 1 and tier 2. I think they do it in India as well. I know this isn't in North America, but I'm curious actually what it would be like in North America, or even if it exists. But it says here, independent living individuals in tier 1 and tier 2 cities like corporate professional students struggle getting laundries done due to no doorstep delivery, zero access to multiple laundries, 4 to 7 days long service periods.
I mean, I think that the language could be smoother, just to sort of be a little more clear. I think I understand the problem, but I just think that I would structure this a little bit differently. I'd like to see maybe a visual with instead of the no doorstep delivery zero, and this is where you and I might differ.
Sure.
I'd like to see something that shows me somebody struggling, like one of these corporate professionals and students. This is where I actually would prefer to see one of those people, because I would probably say, oh yeah, I've been there, or I've seen that.
Yeah, nothing wrong with creating empathy when it comes to your user, 100%. I liken this to a startup that I was advising last year, and it was about delivery for ethnic foods. And it wasn't just like your grocery, like vegetables. It was like ready to cook stuff that was kits, but it was all ethnic. And I said, who uses this? And how do you get your margins and stuff? And they said, Ed, engineers that get hired and they're flown in and they live here and they're from India and they want home cooking and they make a ton of money, but they live downtown. They probably don't have a car. Parking's expensive. So they'll pay for delivery because it makes sense for them. And I said, okay, that makes a lot of sense. So we need to quantify that. In this case, what I would say is if you could figure out the problem statement and say how many professional students or what percentage want to do laundry, but they can't because they don't have access, just straightforward, I think that would go a lot better instead of solving multiple problems, because a problem could be it takes 4 to 7 days to do laundry and we make it better. Okay, that's one problem. You know, like you don't have access or they don't want it. Like just explain what the problem is. And we have zero access to multiple laundries. Well, just say straightforward, like just like a food desert or, you know, grocery store desert. It's like they don't have access and they would pay for it, and just be super clear of it. And, you know, struggling to get laundries done due to, just say how many there are and this is what they want. All right.
Yeah.
I think that's a good one. Okay. Next. So Sneeko, laundry delivery, last minute, last hour. Sneeko. Oh, by the way, I'm just going to say right now, just get rid of that. Get rid of this right here. Everyone, you don't have to put the marketing slogan and all this stuff. So just get rid of this here. Okay.
That could be on the cover page. That could be the tagline.
Sure.
Maybe.
Yeah. Things like that. Right. But here, let's focus on this. Sneeko is an app based on an online platform. Okay, that's language. So you just say it's an app that enables users to order laundry from multiple nearby laundry outlets and get doorstep pickup to delivery within 2 to 4 hours. Okay, so let's rephrase this just so that we can critique it a little better. Let's imagine it says Sneeko is an app that allows users to have their laundry picked up and done by local laundromats within 2 to 4 hours.
Exactly. Done.
Okay.
Picked up, done, and delivered within 2 to 4 hours. Yeah. I would just boom, boom, boom.
And if that's all that was on this solution slide, that'd be good enough for you, Becca? Like you understand it?
It would be I'd be fine with that. I mean, I would maybe put a graphic, but that's personal preference.
Sure, absolutely. Okay, so that's great. I like that it's succinct. This is one of the more succinct decks that we have been looking at. So let's move in. So you go problem, solution, and then unique selling proposition. Okay, now here's where you lose us right away because I'm not going to read this.
I'm not going to read this.
Yes. So let's just say, all right, so to this founder, your unique selling proposition is going to be baked into everything, right? So you've already said instant pickup delivery, you know, or like all this stuff. I don't know what this means. Let's just take this slide out and move along here. I don't think this slide is going to help you as far as presenting to an investor, because you saw our immediate reaction, me and Becca. Actually, Becca, talk to us about your immediate reaction to a slide that looks like this.
It's too much. I don't want to read it. It's the font is small. There's, you know, different colors being used. I just don't want to use it. I also don't use acronyms at the top unless I've already explained what I'm talking, like the USP. I would actually spell that out, because until you have used it in full form, I wouldn't then use the abbreviated. So that's number one.
Yeah, you're taking for granted that they would know, and you're potentially causing some friction. So just overall, like you see, we don't look at slides with walls of text and small text, and the burden is on the sender. This is what Ryan Rattan was saying the other day. Burden is on the sender, not on the reader. So the burden is on the founder, not on the investor to understand the slide. Okay, moving along. Okay, so this is a product. This has got pictures, which is great. So it's got interface. So it says the product mobile app. So it says enable location and view nearby laundries. Available laundries display to choose. So you pick it up, you pick one, choose the desired service.
Yeah. Pretty straightforward. This is my favorite slide so far.
Okay, great. And this is from a user perspective. Now, I just going to say, this is where I have a little bit of a problem. So I have a little cognitive dissonance here. Whenever someone tells me, makes me a promise, like, I don't know about you, Becca, but if someone says instant delivery, instant pickup and delivery. I go, okay, if you could pull that off, awesome, but I don't believe you until you can prove it to me. So what I'm missing on this product slide, or I'm hoping it comes later on, this is just what I'm thinking is, how does the laundromat get this and make sure and have the capacity and all these things? Like, what have you done to make sure these laundromats are on board with you? Like, we have a flower company, delivery company, and they just do a better job at delivering flowers and making sure that it's not standardized bouquets, like custom stuff. And I asked them that very question. They said, oh yeah, we made a deal with the florist and we understand we actually provide the supplies and the material and we're part of their supply chain. So they ensure that quality. That's what I'm thinking right away when someone makes a big promise. Becca, what do you think?
Yeah, I totally agree. And I think that goes to the slide before where I think you have to clarify that this is a mobile app for an individual user that needs to do laundry, but there are also probably benefits for these laundromats, which you can go into later in the deck. But
Yes.
I think you kind of have to set up like who participates in this app that I have.
Okay.
So yeah.
That's good. So now we got the mobile app. So it continues on. Now, this is where you could have had all this in one slide if you designed it, but we are adding close to the basket. View summary checkout order successfully placed. Great. I like that customer journey. I'd say put it on one slide if you can. So here's the business model. This is how we make money. We take 20% commission on total cart value from all vendors. And it's got all this information relevant to India, I believe. I think that, Becca, I don't know what your thought is, but you could have just said this right at the top.
Yeah,
We take 20%.
I agree. Yeah.
Right? Okay. So let's do that now. We're running out of time, but let me just look at these other slides here. Market size validation. So the TAM, global retail laundry market size. All right. So I'm just going to go into this real quick. That's not your TAM. All right. This is not your TAM. This is a top down. That's not your TAM. That could be all sorts of things, dry cleaning, this and that, like detergent, coin laundries, etc. So you want to do it bottom up. I'm just going to be very clear as founder. Figure out bottom up analysis and how many potential users have and multiply that by how much they're going to charge or how many laundromats are going to use the service times, how many people you think are going to use their service and how much money you think you're going to make. And then you've got the Indian market, which is great. That's fine. I understand. Same analysis. And then SOM, this is where you're jumping the shark because and this is expression. Your SOM is, this is what we realistically believe that we can make if we execute our business plan, within a period of time. And you're saying you realistically believe you can make $9 billion, right? I'm immediately checked out. Becca, this will be the last comment to you. What are your comments on a slide like this?
Yeah, it's not reality. So I think the SAM number, the 20 billion, that's really the TAM because I think you're operating in India. So that's really where you're going to be able to, that's the TAM in my view. I think the SAM is kind of the tier 1 and tier 2 and 3 cities or the cities where you're going to have your focus, whatever I guess that number becomes. And then I think the SOM is really quantifying that 17 to 35. What's that population? Is that 10 million, 100 million people? And then what percentage of it do you think you can actually try to target based on income or locations and things like that? So that's going to be a much lower number, but it's way more realistic.
There you have it. So that's the initial reaction, gives you a little bit of taste on what to expect when, individuals who've been around, I'm not calling Becca old, experienced, right? An expert in their field. And we've looked at dozens of pitch decks on a regular basis. Like I look at like 10 pitch decks a day, and Becca is helping companies raise money. She knows what it's like to raise money. So this is how someone like her would react to your pitch deck. Thank you so much for sending that in. Becca, as always, such an amazing conversation. It's great. Give a little shout out and invite people. How do you want people to contact you?
Great. This was so fun. Thanks, Ed and Jen. They can contact me through Startups, through Slack, if they're part of the community, through LinkedIn, Becca Brown, Core Satellite Partners, and hope to meet many of you and see many of you tomorrow at my CPG meeting.
We will include all that information in the description. We are here every Tuesday, Wednesday, and Thursday. Make sure you do the social media thing, like, comment, subscribe, share us out there. We've got some really great episodes coming around and planned for the next week. Becca is going to be a regular, so get all your CPG questions ready. Once again, Jen, thank you. Becca, thank you to the audience. Great questions today. Everyone, we'll see you in the next episode.